We're going to go through a practice exercise that hopefully will show you the details behind the financial statement numbers and how the cost management concepts that we read about in Chapter 2 support the financial statement numbers in more detail at the product level. Let's take a practice exercise of ABC Company. A company that began operations this year. It sells one major product called the Wise Widget. It gets $400 per Wise Widget unit when it brings those widgets to the market. And it has a manufacturing cost breakdown here. Some variable costs. It has direct material of $50 per unit. Direct labor of $75 per unit, and some variable manufacturing overhead at $100 per unit. During the year, it incurred fixed manufacturing overhead costs of $2 million. It incurred costs of selling and administrative $1.5 million. For the whole year, it sold 40,000 of these units, and it produced 50,000 of them. The company carries its finished goods inventory at the average cost of the product. That includes both variable costs and fixed costs. The company is subject to a 50% tax rate, and at year end it didn't have any work in process inventory. The only inventory it had left was finished goods inventory. We're going to look at these the situation and these numbers, and the first thing we're going to do is determine what was the cost of the year-end finished goods inventory at the end of the company's first year. And then after we determine that, we're also going to compute the net income for the year, looking at these numbers. Let's start with part 1. To solve this problem, the first challenge we have is to look at one unit of product and make sure that we understand what the total cost is to produce one unit of the product. If you look at the layout of the information that was provided for us in the problem, it gave us the unit costs for variable costs, but it did not give us the unit cost for fixed manufacturing costs. We need to add that into the unit costs for material, labor, and variable overhead. So our first step is to calculate the fixed overhead per unit. The $2 million is the fixed manufacturing overhead for the year, and if we divide into that the number of units that were produced during the year, that will give us the fixed manufacturing overhead per unit at $40 per unit. So then we can do a summary, and the second step we can calculate the total unit cost of these Wise widgets. We'll pick up the direct material, direct labor, and variable overhead that was provided for us in the problem, and we add in the fixed overhead of $40 per unit to get us a total average cost per unit of $265 per unit. That means every time they manufacture a Wise widget, it costs them $265 to do that. Second challenge we have is we don't know how many units we have in ending inventory. In order to calculate that, we start with the beginning inventory at the beginning of the year. Well, the problem stated that this was the first year of operations. So in the first year that you operate, you don't have any balance in inventory because you start the year at 0. So we then add to that all the units that were produced during the year, and the problem said we produced 50,000 units. We take away from that any units that were sold. They were shipped to the customers and sold, and so that leaves us with and that was 40,000 units that we sold during the year. And so now we have an inventory at the end of the year of 10,000 units. Now once we know how many units we have in the ending inventory, and once we know what the value per unit is that we calculated in our second part up here, we can multiply the two. We take the units in ending inventory of 10,000 units times the cost per unit of 265. So our ending finished goods inventory value is $2,650,000. And that satisfies the first requirement of what was the cost of the year-end finished goods inventory. Now let's take a look at the second requirement. The second requirement is to compute the net income for the year. Now let's remember, as we do this, from our previous slide, we had in part one, we calculated that the unit manufacturing cost was $265 per unit. We just pull the numbers from the information provided to us in a format that is takes from our income statement. So the first line would be the sales revenue. Well, we know we sold 40,000 units, and we know that they get $400 per unit. So 40,000 times $400, we had sales for the year at $16 million. Now, what was the cost of those units that we sold? Well, it would be the same 40,000 units times the $265 per unit, so that we have a cost of goods sold of $10,600,000. When we subtract that from the sales revenue, that gives us a gross margin of $5,400,000. So that's our margin line. From the margin, we subtract selling and administrative expenses, and those were $1.5 million. And that would tell us what the income before taxes is, and that's $3.9 million. Now, income before taxes is the number that is used to calculate what our taxes will be. And in the problem, they told us that the company is at a 50% tax rate. So we take 50% from the $3.9 million, and that comes out to be 1.950 or $1,950,000. And then we have left the net income of $1,950,000. This is how you would summarize an income statement. Notice how we went from a unit value in terms of coming up with the manufacturing costs, and that we were able to pull together with those numbers. Using our cost information, we were able to come up with the top-level financial statements for the company. So this gives you a look at the details behind the top-level numbers in the financial statements, and allows you to see how we look at the unit cost in a product. And that's exactly what supervisors are mostly interested in. Your manufacturing supervisors are very interested in what it really costs them to manufacture one unit of the product. As we go forward in the course, we're going to see how do we manage the material cost, the labor cost, and the overhead cost. How are we able to be more efficient or more cost productive in getting those costs down as low as we can? And the lower our cost of goods sold becomes, the higher our margin will be and the more income we will have.